to get started. Thank you, clients, friends, new people joining us this afternoon. We're very excited to bring to you this afternoon some content we hope you find very informative and educational. Here at Liberty Wealth Advisors, we're seeking to provide you with ongoing educational information for you, and we'll be doing this as a series of one of other future webinars yet to come on various financial planning topics. So we're delighted to have you here with us this afternoon. Before we get started and get into our discussion today on risk tolerance, I'd like to just address a couple of housekeeping items. We will be doing a question and answer section after the end of today's presentation. And so I'll draw your attention to the bottom of your screens here on the Zoom webinar platform. There should be an icon that says Q&A, where you can feel free throughout the presentation to drop in a question. And if time permits at the end of the presentation, we'll get to those questions and hopefully provide you with some helpful answers to what's top of mind for you. All right, jumping right into our agenda this afternoon, we'll do a very brief touch on Liberty Wealth Advisors and some of the additional services and resources available to you and ways in which we can help you. And then we'll jump right into our discussion on what is risk tolerance, how to determine your risk tolerance, how to align your goals and objectives with an overall financial plan, how does diversification play an important role in this overall conversation, and just creating all of this alignment together and how that will help you in your financial future. But before we get started, allow me the pleasure of introducing our speakers this afternoon. So we'll have three presenters here. First, starting with Jen Flaherty. Jen is one of our advisors on the Liberty Wealth Advisors team, has been with Liberty Wealth for well over 10 years. Interestingly enough, this is a second career for her. Prior to working with Liberty Wealth, she was a chemical engineer in various leadership roles, working on process improvement. And that process improvement mindset, I think, certainly lends very well to being a financial advisor and a certified financial planner. Joining Jen is also Mike Perry. He's our Director of Wealth Planning here at Liberty Wealth, has over 30 years of experience, so certainly bringing a lot of expertise to today's conversation. Also a certified financial planner, specializing in many different areas of the wealth planning and financial planning process. So Mike will be lending some of his expertise to us this afternoon. And then also joining us from our partners at Prime Capital Financial is our National Director of Financial Planning and Client Experience, Mary Lucas. Over 26 years of experience, not only in financial advisory roles, management, leadership, but really is at the forefront of holistic financial planning and bringing all various disciplines of your financial life together to create a holistic financial plan. So folks, we've got well over 50 years of experience here weighing in this afternoon on today's conversation on the importance of risk tolerance. And so to kick things off, maybe Mary, I'll kick it over to you to just talk briefly about our broader services and resources available to clients working with us.
Thank you, Annette. I'm really happy to be here today. And I mostly want to start by just reminding everyone that's joining the call today that you are in very good hands with your Liberty Wealth advisor, because Liberty Wealth is truly a full service financial company. Our advisors have many tools and resources at hand to help assist you with all of your financial needs. As you can see highlighted on the screen today, our team has the services that include everything from a robust investment management platform to, of course, full-scale financial planning. And within the full-scale financial planning unit, we offer things such as insurance analysis, education planning, as well as estate planning. We also offer retirement plan education and financial wellness and several other services that you can see highlighted on the screen. And while you may not need some of these services today, we all truly understand that your needs will change over time. And the point here is to know that when the time comes for you to need to tap into one of these services, your Liberty Wealth advisor is truly going to be able to help you with that, whether that be 5 years, 10 years, or 15 years from now. And of course, from where I sit, financial planning is an integral part of every client advisor relationship. And I know that all the Liberty Wealth advisors feel the same way. And our core belief is that the financial planning process never ends. Similar to a circle that has really no ending point, neither do our financial planning conversations or our individual planning conversations with our clients. We start any client relationship by defining your personal goals and objectives. And then from that, we formulate a strategy that's going to help you to achieve them. And of course, at the start of any effective financial planning discussion, we're going to talk about risk tolerance. And that's really the key to what we're talking about today. And from risk tolerance, that's how we help determine your personal asset allocation and your overall investment strategy. So I'm really excited as we move through and hear from the advisors, learning a little bit more about risk tolerance today and how that translates into your personal long-term financial strategy.
Thanks, Mary. So with that background in mind, let's start out at, I guess, a foundational building block concept. Let's level set everyone. Mike, what can you just share with us about what's important to consider when we're just talking about risk tolerance to get started?
Thank you, Annette. As we consider topics for our first webinar, this subject about risk struck me as timely, as stocks have done exceptionally well for the past couple of years. Better to learn about risk before a market downturn instead of after. We've all heard that investing involves risk, but what does that mean? Risk is all about uncertainty, and unfortunately, the more you know about investments does not necessarily make you more certain of the future. We hear a lot about risk in the media when stocks go down, but what about when the equity markets are doing really well? After all, volatility applies equally to investments going up as well as down. Poor investment outcomes usually occur because of emotional reactions to market conditions. Avoiding knee-jerk changes to investment portfolios is key to consistent long-term investment returns. The ability to handle the ups and downs of investing is what risk tolerance is all about. Regardless of how you invest, the value of your assets is impacted by factors beyond our control, like taxes, health, inflation, and interest rates. Of course, indecision is always possible when we're overwhelmed with information, which can have an adverse impact. Investing is a must if we want our money to grow and beat the impact of taxes and inflation. But how can we get comfortable with the ups and downs that comes with investing? After all, the best returns come from the riskiest and most unloved investments. The ability to tolerate risk is unique to each individual and can be influenced by age, investment experience, and even family history. Getting the right mix of assets that aligns with your risk tolerance is one of the most important responsibilities that a financial advisor has. Conversations between advisors and their clients are key to gaining that understanding and in turn the construction of a portfolio. Updates to your financial situation, investment goals, and time horizon help advisors adjust investment recommendations. Even a passing comment about recent market volatility can help align risk tolerance with a portfolio's asset allocation. Risk is typically associated with the value of an investment going down. However, the measurement of risk also includes price movements up and down, because if an investment can go up 10% in any particular time period, it can have a similar movement down as well. All investments carry some level of risk, and recommendations from your financial advisor aligns investment risk with each client's unique situation. Now, risk is inevitable as we navigate through our lives and is more obvious in some situations than others. However, when it comes to building a portfolio, risk comes in many different flavors and may not be obvious due to the complexity of financial markets. Investing involves buying stocks, bonds, and other securities in hopes of increasing the value of those investments through market gains, dividends, and interest. Stocks represent ownership in a company with the hopes that its earnings will grow. bonds or loans to governments, municipalities, or corporations, where you're paid interest on the money lent. The longer the loan, or more uncertain the prospects, the higher income you receive. Returns are not guaranteed with stocks and bonds, and you take the risk that holdings may lose value. Of course, the higher the risk, the higher the potential returns. Investing in safe investments such as CDs, treasury bills, or a savings account may not allow you to meet your needs over time, especially when you consider inflation, which erodes purchasing power. Remember, all investments carry some level of risk, and your financial advisor can recommend an appropriate mix of investments by understanding your goals and time horizon, as well as your ability to tolerate volatility. A good working relationship with your financial advisor is essential to make sure that your portfolio matches your risk level to allow you to sleep comfortably at night. This is especially helpful when combined with a financial plan to stress test your situation. Back to you, Annette.
Mike, thanks for that overview. Well said. And I think sets a good backdrop for determining your risk tolerance. So how did we get started, Mary? Oh, Mary, I think you're on mute, actually.
Thank you.
Oh, you're welcome.
Appreciate that. And we know as advisors that your goals and your spending needs are unique, and they will definitely change over time. And as Mike pointed out in his comments before, this all revolves around a financial plan. And we need to know that when we're coupling your short-term and your long-term goals, we also need to take into a factor the risk tolerance. And you can see, by the scale on the screen right now, the risk tolerance is a range. It's not as simple as high and low. There's actually different levels of risk tolerance that may apply to you in your personal situation. And the thing for you to keep in mind is that your risk tolerance does relate directly to how you feel about any fluctuation in the market. So if you're more on the low risk side, you're going to fall into more of a conservative category, which means you don't want to feel any of the fluctuation in the market. And there's nothing wrong with that, but you also need to understand that your time horizon will be set a little differently because of that. It will take a longer time for you to reach some of your short and as well as your long-term goals. Now, if you fall more into the high risk side of risk tolerance, you're willing to experience some of that fluctuation in the market. You may see some nice spikes and gains in the market from time to time, but the other side of that is you, of course, can see some of the downward trend. And there can be a blend of the two, as that's what you're seeing in a moderate risk tolerance, where you can take a little bit of risk and understand some of the highs and lows, but you also don't want to see, you also appreciate some of the common times when you're not fluctuating in the market. So it's all part of that overall conversation of making sure that your risk tolerance is in line with your long-term goal growth long-term expectations. And to share a little bit more about this, I'm going to pass it over to Jen. She's going to dive a little bit deeper into the risk tolerance conversation.
Thank you so much. We have several tools we can use to help determine your risk tolerance, such as questionnaires, a program called Nitrogen, which was formerly called Riskalyze, as well as working with one of our experienced financial advisors, such as Mike or myself or other certified financial planners on our team. As with everything that we do, we believe in passionately doing what is in the best interest for those we serve. So the way we do this is we listen to you and we try not to talk over you. We learn what is important to you, and we also try to understand how you behaved in past stressful periods so that we can understand more about your psyche with your risk. And this can be very telling. We also make recommendations that are in your best interest. So by pulling together your financial threads, we'll recommend an asset allocation that's appropriate to meet your goals while mitigating the exposure to risk that is appropriate for your mindset. Even better, a financial plan reflects your current situation and your goals, and it's helpful to stress test your asset allocation. So by having this right, this is something I call sleep insurance, by not having to worry or be kept up at night thinking about this. Of course, when things have changed, we'll want you to tell us so we can work with you to determine if things need to be modified. So far, we've been discussing different types of investments, such as stocks and bonds and the risks involved, along with common terms in our industry to describe typical risk tolerance categories. And so this slide is showing some examples of stock to bond exposures for the continuum of risk tolerance. In the light blue, you have stocks that are represented, and then the dark blue is represented by bonds. And if you start on the left-hand side, you'll see the conservative portfolio in this example has about 30% stocks, 70% bonds, and then you move more towards the stock allocation as you go towards the aggressive portfolio. And so the aggressive portfolio is going to have a lot more risk. Some of it is good volatility and some of it is bad volatility. And most people are worried about the bad volatility or the downside. Since investments carry different levels of risk, it's possible to tailor your investment portfolio to align with your risk tolerance. So by having your advisor understand your goals and your ability to handle risk, we can recommend an appropriate allocation, which usually starts with a broad asset class of stocks and bonds. Generally, the more willingness you have to take risk, the higher allocation you're going to have to stocks. But just because you're willing to take more risk doesn't mean you should take more risk. And that's where having conversations with your advisor is helpful. We realize everyone is unique and their situation is too. So having a cookie cutter approach for all portfolios doesn't always make sense. Please talk to us so that we can help determine how much risk exposure makes sense for you. As your time frame gets closer, as you approach your goals, consider adjusting your risk levels to stay on track. For example, portfolios may become more conservative as one approaches retirement, not just because you're getting older and you may be less open to risk, but also because you may need to have the portfolio generate some income. With the understanding of the income that's coming in, such as Social Security, possibly you have a pension or two, those are the lucky people, of course, then we can determine how and if an investment portfolio can generate the necessary income to meet your goals. Typically, withdrawal rates are around 3 to 4%. When withdrawal rates are higher or high, that can increase the possibility of your portfolio value going down. Of course, there are limitations to how much a portfolio can be expected to return. And so with a higher withdrawal rate, that has a tendency to push you more towards needing a higher allocation to stocks, which may not be your best interest. There are many rules of thumb for coming up with how much stock exposure you should have. You may have read that you take 100 years minus your age, and that's your stock allocation, with the rest being bonds and some cash. I've also seen 110, 120 years used since people are living longer. And this is similar to how a target date fund works, where they're looking at the target of when you want to retire, then they adjust your stock to bond ratio accordingly. But this doesn't consider when you'll need the money and how long you need the money to last. One of my clients who was 101 years old, we had conversations about this, and he'd say, Jen, your time horizon is much longer than mine. And we talk about this. And in reality, he really wasn't taking a bunch of money out. He wasn't trying to spend it all. And I kept trying to show him that. And then when he was able to articulate what was most important to him was to have his portfolio there to support his second wife and then go to his children, this provided a new vision for his time horizon to him. So we were able to agree upon an asset allocation that made sense. And this is an example of how conversations with your financial advisor can help.
Thanks, Jen. That's a great example. And I think just really dovetails on to this whole topic of it's more of an art than a science of making these elections. Thanks for that background. Related topic then that is part of this recipe is this topic of diversification. Mike, what could you share with us about how diversification plays a role here?
Sure. Well, as Jen showed in some of the prior slides, the combination of stocks and bonds is an attempt to reduce risk by varying the types of assets that you invest in, knowing that they'll perform differently over time based on historical data. It's important to recognize that this does not prevent losses. But having a diversified portfolio can help spread out the exposure to different types of risk and minimize the impact of market volatility, which then in turn helps to manage anxiety when markets go through an inevitable downturn. In addition, investment experience can provide a level of understanding of market volatility, just like gaining confidence while driving on a highway. Advisors have many tools to illustrate the concept of risk to clients using data that measures volatility. The chart shown here is a visual depiction of risk versus return. Here we're showing the average return on the horizontal axis and a 10-year measure of volatility on the vertical axis. The various stock and bond funds in the portfolio are reflected in the yellow dots in the graph. Bonds are in the lower left quadrant and stock positions are in the upper right-hand quadrant. The blue square in the crosshairs represents the benchmark that has been assigned, and the red triangle in the center is the entire portfolio. As you would expect, investments mostly fall within a channel from low risk, low return holdings in the bottom left to higher risk, higher return holdings in the upper right. If we were to add a single stock, Apple, for example, it would be way off the chart to the upper right-hand corner. High risk, high returns. Conversely, adding more bonds to this portfolio would shift the red triangle down and to the left, meaning lower risk and lower returns. Next chart, or next slide, Annette. Yeah. So on this page, we show our quilt chart, looking at the annual returns for a range of different asset classes across 14 years. It includes different types of stocks, bonds, as well as commodities and cash. Each asset class has the same color for each year, which is shown across the top. Assets are arranged from highest to lowest return for each year. And cutting through the middle of the chart is a hypothetical diversified portfolio comprised of different weights of these asset classes. Holding different types of investments helps avoid big declines in down years. Since leaders in one year could be losers the next, diversification helps to lower risk and provide a more consistent rate of return. Over time, diversifying across asset classes helps to manage risk and potentially boost returns.
Thanks, Mike. You know, like diversification and how that's so important, an important element of this overall recipe, we could also say this concept of staying the course is also an important factor. And what do we mean by that? I think we're talking about, Jen, these times where it's getting bumpy and choppy in the markets and it makes people nervous, right? So what could you share with us, you know, your thoughts on this topic of staying the course throughout so many different market cycles?
Sure, I'd be happy to talk about this. So certainly after having the right asset allocation determined and having a diversified portfolio, the next is to do no harm and let your plan work. So we really encourage you to stay the course until something changes. And then that's when you simply reach out to your advisor to let them know that you need to have a conversation. Now, every financial advisor is going to tell you that past performance does not indicate future returns. And that's something we all have to memorize as financial advisors. But also, it's important to look back and remember how markets go up and down. And this is part of investing. Parts are really fun and parts are not so fun. Bear markets, not so fun. Those are defined as a 20% or more decrease in prices. And this is when your asset allocation is truly tested because the news cycle is more doom and gloom and the economy is slowing. Things just don't feel right. But this too shall pass. Bull markets are much more fun. There are upward trends in the market and a plus or minus or an additional 20% or more increase in prices. And I feel like it's the down markets that really catch you and challenge you and challenge you to try to do something different with your money, or maybe you should make a change. So This is why it's important to understand historically what's happened. In order to pursue a greater return, it may mean just to stay the course and get through this challenging time. With bear markets, those tend to be shorter than bull markets. And you can look at this chart from 1980 through, this is June 30th, 2024. But bull markets last about 9.6 months and bear markets last about 9.6 months. Bull markets last around 2.6 years. So there's a big difference in magnitude. And bull markets can happen, they can start during an economic recession, during expansions, and at all rates. And so while it's impossible to predict when a bull market's going to begin, it's possible to miss by waiting out on the sidelines. So when you're looking at this chart, this is looking year by year from 1980 through June. And on each year is represented by a vertical black bar. And each year has the return that was annualized for, the number is the annualized return for that chart, for that year. The red dot represents the worst decline in that respective year. So even though we look at this and most of the bars are above the 0 line, the 0% return on the y-axis, there were times that the markets did poorly during that year, and we have to remember that. So the important part to remember is the red part's going to happen. You're going to have normal downturns during each year and each market cycle. And some of the best things you can do is to stay on course, especially during challenging times, and then not to get too greedy when stocks are doing well. Bear markets are painful, but markets are positive most of the time. So the key takeaway is to stick with your asset allocation during all markets. Here's another way to look at the S&P 500, which is 500 of the large US stocks. And this also begins in 1980. And it's a time frame that looks at different crises that occurred, such as Black Monday in 1987, when the S&P lost 20% in one day, the dot-com bubble in 2002, the global financial crisis, which was over 2007 to 2009, and then the start of the pandemic in 2020. There are many challenging times, and for those reasons, we want to kind of stay the course. Sometimes crises can lead to fear, and then it propagates public perceptions to be pessimistic. And so we need to realize that markets don't like uncertainty, and that can fuel a lot of volatility in the markets. But the US market has proven to be remarkably stable and resilient, and historically it has recovered from short-term events with higher long-term periods. So despite recessions, wars, crises, things like that, the annualized return of the S&P 500 from 1980 to 2022 was 10%, excluding dividends. By staying invested or adding money, if you have money on the side during market downturns, that's a great time to take advantage of fluctuations in the market valuations. You can stay on track and pursue your long-term goals. So investors who stay the course can benefit, as one doesn't know when we're going to have the best or worst days until after they occur. When markets have a significant and quick downturn, it may feel safe to take control, to get out of the market, to do something. You just want to do something. And when you have this impulse, remember, we are here for you. Don't wait for a scheduled meeting. Don't hesitate to reach out, especially during these trying times. It can be helpful for us to hold your hand, sometimes virtually, to have someone you trust that you can talk to talk you off the ledge and put a pause between your impulse to do something. So we're going to remind you that this too shall pass. Historically, some of the best days occur around the same time frame as the worst days, and that can have a huge impact on your returns. So historically, 7 of the 10 best days occurred within 2 weeks of the 10 worst days. So try to stay the course. In this chart, it shows a $10,000 investment over a 25-year period, starting in 1998, and staying the course would have had that $10,000 grow to over $417,000 by the end of last year, despite the 49% drop in 2008. So just missing out on the best 5, 10, 30, 50 days can have significant impacts on your returns. Now, my regulatory side needs to note that these returns reflect this time frame. Other markets may be less favorable, and then some market segments may not have recovered from this downturn. But really, what is important? The importance is take advantage of time, not timing. Be disciplined and don't miss out on the market's best days. And then work with a financial advisor to determine your asset allocation that's appropriate for your risk tolerance. It supports your goals, your time horizon, and as well as when you have concerns or changes to your financial situation.
Thanks, Jen. In particular, those last few slides are just so illuminating with respect to we can be our own worst enemies, right? And just the importance of having a trusted partner to talk through that. And perhaps then this could bring us to some final thoughts on everything that we've discussed thus far. So thank you, Mary. Thank you, Mike. Thank you, Jen, for sharing your insights here this afternoon. Perhaps we could distill everything down to a few simple bullet points. When determining your risk assessment and your risk tolerance, it's probably best done and accomplished with a trusted partner and a professional who understands so many of the nuances and can really work through refining something that's specific and suitable for your situation. Keep your time horizon in mind. It may be longer than you think, and you could have a longer runway to manage accordingly. Diversification is key, and trying to avoid the pitfalls of emotional investing, trying to time the market. Sometimes I call it getting cutesy. Again, I think it just reinforces the idea of working with a trusted advisor to communicate well and thoroughly regarding your specific financial situation. So we're nearing the end of the presentation. Some invitations or some next steps, and we'll get to your questions here in just a moment. I see a few that have come through on the chat. We hope you enjoyed today's webinar and presentation. We're committed to providing you with additional educational content, and we hope to do more of these in the future. After today's presentation, we'll circulate a recording. Please share that with friends and family, or if you know of someone who could use help and assistance like this, send them our way. Have them watch this webinar. Reach out to us. We're here as a resource to help you, family, friends, in whatever way you think would be helpful. Perhaps an invitation. I'm pulling up here on the screen. There's a QR code that you yourself can take, or you can share this, with friends and family. It's a complimentary and confidential risk assessment. Jen earlier had mentioned one of the tools that our team will utilize to start this conversation and refine some decisions about what we're doing with our risk and our asset allocation. This will take you directly to the Liberty Wealth Advisors website. You can go to libertywealthadvisors.com directly and click that button there at the top. Get a free risk number analysis now. It's a short and sweet initial preliminary risk assessment. And one of our team members and advisors, certified financial planners, will follow up with you directly thereafterwards to have a more in-depth conversation about everything that we've discussed today. So that's an invitation for you to certainly take us up on that initial discussion and begin the process of seeing how we can best help you with your specific financial goals and objectives. And with that, we'll move over to some of the questions that we've seen come through here. So this is open for Jen, Mike, Mary. Question here: how often should we revisit our risk tolerance? What do you guys think about that?
I'd be happy to chime in here. Certainly regular check-ins with a financial advisor is important, and the timing is not the same for everyone. Certainly whenever there's significant changes in an overall financial situation, for example, making the decision to launch into retirement certainly would be one of those situations where reassessing risk tolerance would be appropriate. Anytime you're feeling anxious about the markets, would be a good time to check in with a financial advisor. But absent that, an annual review is always it is very helpful to make sure that the portfolio still maintains the asset allocation that was just initially decided upon, and provide that check-in to see how you as the client are feeling about the ups and downs in the marketplace.
Right. Thanks, Mike. It looks like here's another question come through. I have some assets to invest, but I'm nervous about volatility prior to the election. Okay, Mike, you were just talking about when people are feeling nervous about what's going on in the market. So the election, that's a big one. What do you recommend is the second part of that question.
I'd be happy to talk about that. I think certainly having an emergency fund and having a buffer so you're not investing money that you need right away is helpful. Certainly for people that are dependent on retirement assets, their money, they may be taking some money out as a required minimum distribution or as a distribution, but they're not taking all their money out. So when you think about adding money to the markets, sometimes it's helpful to have systematic investing where you add a chunk at a time and ease it in. And sometimes you can take advantage of the market lows and buy a little more with those dollars versus when the markets are up. And that's a helpful way to ease back into the markets.
Great. Well, that, is timely, and actually there'll be volatile times in the future. And so, again, to that point of there's a few things advisors can help you decide and navigate through, but good advice as far as make sure we're not investing anything outside of that emergency cash reserve. Thanks, Jen. And it looks like we have time for a final question here. Should I have a consistent asset allocation across all my various accounts, both retirement and taxable? What do you guys think about that?
I'll speak.
Go ahead.
I think having an overall asset allocation is helpful for a client to understand how much risk they're exposed to. But when you break down the different components of the types of assets you have, I don't think one size fits all. And it really depends on working with the client so it makes sense for the client. And so Roth IRAs, which grow tax-free, and they have no required minimum distributions, they have no requirement to take money out. And when you take it out, it's tax-free. Those are usually one of the last accounts that someone uses. And so those I tend to lean much more towards equities where they can grow. You can put more risk in there because you have time on your side. And then trying to make sure that each account or group of accounts is appropriate for where the client is. But I do like to have it make sense to them so that helps them sleep at night.
Okay. Well, thank you. Thank you, Jen, Mike, Mary. I think we got to the end of our questions here. Let's see if another one's come through. No, actually, so we'll conclude then. Thank you, everyone, for joining us this afternoon. We greatly appreciate the time we spent with you here today. We look forward to doing another event like this in the future. And certainly, the invitation is open. Do not hesitate to reach out, utilize the risk questionnaire, go to the Liberty Wealth Advisors website to learn more. So thank you, everyone. Have a wonderful afternoon.
Take care. Bye-bye now.
Thank you.
Bye, everyone.